What's up, everybody? Matt Faircloth and Hervé Francois here, coming from the DeRosa Group. Hervé, guess what, man? We are live on LinkedIn. Not just LinkedIn. We're also live on YouTube, but not just YouTube. We're also live on the DeRosa Insiders page. Isn't that crazy?
With three-way live.
Three-way live.
Wow.
Trifecta, if you will. The triple crown of lives.
Very
We're triple live, you
good.
know? Did that guy from the Yankees get the triple? Did he do another home run last night or no?
You know what? I think he's stuck, man. I think he knows that if he gets one more, he's going to be tied, and like he's doing exactly.
It's in his head.
Dude, apparently the family was there last night. They're waiting for him to go ahead and tie their fathers and grandfathers.
Oh no!
Yeah, he didn't do it. They won, and they're in the playoffs because they won in a walk-off home run. But he did not hit it last night.
Oh man, cool.
He has another chance.
Oh well. Yeah. Well, hey, welcome everybody to the DeRosa trifecta, the DeRosa Triple Crown of live in 3 different places here. Me and Hervé are going to be taking.
I like to say Happy New Year, Happy Rosh Hashanah to many of our fellow DeRosa Insider guests and so on and so forth. So
Happy New Year, man! Happy New Year to all of our DeRosa Jewish friends, and and another year of happiness and blessings coming at you folks. So thank you, Hervé, for saying that. Yep. Guys, me and Hervé are gonna be here hanging. We're gonna hang out for a while, let you guys pick our brains. We'll chat with some stuff going on in the DeRosa world, give you guys some updates there. But I've just dropped the link, Hervé. And so for people that want to come and chat with Hervé and I, pick our brain, talk some real estate shop, throw some spaghetti up against the wall, see what sticks. Maybe you're facing a dilemma real estate wise. You want some ideas, inspiration. You got to just question whatever about real estate. Click that link right there that I just put up into the StreamYard function here. We should have that. If Jordan and Dabiku could spin that over to LinkedIn and DeRosa Insiders, that would be phenomenal. And for those of you guys that aren't DeRosa Insiders members, what I want you guys to do, if Jordan and Dabiku can do this for me as well, is to put on LinkedIn and YouTube. You guys really need to check out a DeRosa Insiders community. It's free, capital F free. Okay. And you guys can just come on there. We do like live posts sometimes. There's people putting out deals. There's people putting out collaborations and stuff like that. It's really interesting stuff and chat that's happening on DeRosa Insiders. And so you guys need to go join it right now. DeRosa Group, or go to facebook.com/DeRosa Insiders. There it is there on LinkedIn. Jordan, if you could post that, or if you could grab that and post it on LinkedIn also, or on Facebook also, that'd be great. Get it on YouTube. There we go. There it is. Thank you. Now click that link, guys. There's a link posted to join us live, the StreamYard.com link. And so we're waiting on folks to do that. Hervé, man.
What's going on?
Fed. They keep pumping rates, man. Here we go.
Them up, man. They keep jacking them up.
What do you think? Are we, doom and gloom? Are we chicken little, sky's falling yet? Should folks change their strategies, their stock investment strategies or whatever? Like, how much is that changing the world? That 75 basis point BIP that we got this week. What do you think?
I don't want to say it's a great question. It's a loaded question. I don't want to say that it's changing the world. I like to think it takes more than 75 bips to change the world, but yeah. It certainly has, an impact on people's financial portfolios. The Fed has been talking about doing this since December of last year. They are carrying through with it. But they're being very aggressive, and they're not hiding the fact that they are being aggressive. So much so, they are willing to go ahead and teeter on taking us towards a recession.
Are you going to say the R word?
Yeah, I just said it. They're teetering on doing that and having unemployment pick up because we have a hot economy right now, or inflation at 8%, and things need to be tampered down. So, listen, I think, financial portfolios, you got to remember, I come from the world of being a 51% optimist. And so I try not to push the panic button when these things happen. The good thing is Hopefully you have been making adjustments to your portfolios since earlier this year, understanding that we were going to be getting into this rising rate environment. And listen, you have to also, I think, be you. I'm also a person who's always, very thankful as well. Look, we've had some just amazing bullish years for the past 6, 8, 10 years, not only in the stock market but real estate, man. I mean,
Everywhere.
we can't let this one year, 2022, erase all of that incredible performance and incredible purchases that we have made in the stock market and real estate over the past 10 years. You guys had to know that, right? The music at the party, right, the volume was gonna come down a little bit, right? And the lights were gonna come back, get dimmed a little bit. And that's really what's beginning to happen. So that's why I'm not panicked, knowing that this is cyclical. This is the other side of the cycle, right? We're at the cyclical part. And then, things are gonna really, start to improve. I'm gonna put it at, probably towards mid to late next year, kind of a thing, in regards to a subsiding of these interest rates. So, I'm not going to be investing. You asked about, stocks. I'm not going to go into, very cyclical stocks. If I'm going to be in the stock market, I'm going to be on the defensive names. I'm going to be in the healthcare names. I'm going to probably be in some consumer names. I'm not going to be in tech. I'm not going to be in manufacturing. I'm not going to be in retail. And then obviously, as you know, on real estate, we're not stopping. We're continuing to look at deals, and we're just going to have to underwrite, more conservative, and understanding that we're going to have to underwrite to higher fixed rate debt. If the deal works, then the deal works. I will be very much looking forward to us refinancing that deal down the road if we got to lock into higher rates today.
Yeah. No, and Hone Tai saying Dogecoin all the way, right? Yeah.
Sold to Hone Tai. Sold to him.
Bitcoin's falling like a rock, man. Bitcoin's at 18.5 right now.
Wow.
Yeah, man. I mean, I haven't seen Bitcoin at 18.5 in a long time.
No long time. I guess it's how are people viewing Bitcoin, digital currency? Are they viewing it as gold? So I want to load up on gold as a hedge against a declining dollar, right?
I think if you track Bitcoin's recent activity, it's linear with the stock market. You put Bitcoin and the Dow Jones Industrial Average together.
Neck to neck.
The Bitcoin swings are more, but when Bitcoin goes up, but when the Dow Jones Industrial Average goes up, so does Bitcoin. When the Dow Jones Industrial Average goes down, so does Bitcoin. It is not anything different than those two things.
Yeah.
Okay, let's get into some real estate stuff, man. Thank you for your insights there.
Absolutely.
Few questions. Let's see. Give Hervé. I got here's this from John Rack on coming in off Facebook. Many tenants request emotional support pets.
Okay.
Even if the lease states no pets. Do tenants need to prove this request from a licensed professional in New Jersey? Here's my take on emotional support animals, right?
All right.
I've had tenants show up, Hervé, with a certificate they bought online for $50 saying my dog is an emotional support animal, right? Emotional support animals are the biggest racket going ever in the world.
Wow.
Dude, I'm going there, man.
Okay. I like you opening it up this morning. All right, baby.
I'll go there. I've had 3 cups of coffee, Hervé. Normally I only have 2, so I've had 3. So this is what happens.
You know why? Because we're live 3 times, baby.
This is what happens with Matt on extra caffeine. Okay,
right.
And more Matt with caffeine and a camera on him. Stand back, right?
I'm afraid of you.
Here's the deal. The concept of emotional support animals is the biggest racket going. It is an insult to people that have real animals that are supporting them. And I don't discount animals as support. There is a documentary on Netflix on the amazing partnership that humans and dogs have, right? Dogs have for generations, thousands of years, been man's best friend. And they are best friends because they can help humans see. There are dogs that help humans that have epilepsy There are dogs that help humans with anxiety. There are dogs that help humans with real diagnosed conditions. And those animals serve a purpose in the world, and landlords should be obligated to make room for people who use a dog for sight or for aid around the house. Or there's dogs that help people, go get things and retrieve things for people and stuff like that in a human environment. That said, it is BS. The industries swing so far to one side that's a lot for any animal to become emotional support. Oh, my parakeet's now emotional support, right? And you can do that. There was a guy that tried to get onto a American flight with a peacock, and he called it a emotional support animal. It is BS. The pendulum has swung way too far in one direction. And I had a tenant years ago in an apartment building that we went to him, was like, hey, you got to pay $35 for your animal. Okay. You got to pay a $250 one-time pet fee and a pet rent of $35 per month. He came back at us saying, no, it is an emotional support animal. Then that gets me out of paying those fees. No. Here's the thing, right? There is no rule that I've seen that says that that an emotional support animal, or even a service animal, a real seeing eye dog, right? Your seeing eye dog still may take a pee on my floors, right? Your seeing eye dog is probably still going to smell like a dog. Yes. Okay. They don't not smell like animals anymore. Okay. So there's no rule that I've seen that says that real service animals, not BS emotional support animals, right, are not obligated to pay fees, right? It is not anything that circumvents you, but it does say the landlord can't say that a blind person can't have a seeing eye dog. I don't know of any law that says that you can't charge a tenant with a seeing eye dog a pet fee.
Yeah.
Right? No rule that I've seen on that one. I challenge anybody to give me that one. Yeah. And we actually won in court against a tenant that tried to show up with a BS certificate. I'm trying not to swear, but a BS certificate he bought off the internet for $50 that said his dog was a service animal, and he lost. Okay. No. Sir, pet is that's still a pet fee, non-refundable pet fee, and pet rent. Boom. So there is so John Rack, there's no rule that says that you have to accept that dog or that you can't charge fees on it. Okay. Charge your fee. You're entitled to it. No rule. No, they're not a protected class. Let's put it that way. Okay. Moving on.
Listen, that's good stuff, man. That's good stuff. Your passion and emotion on that topic. It's very, very passionate.
Yeah. Here we go. Wait. Yeah, I'm very bad. No, it's just I've been pinched on that one before, and
yeah, it sounds like it, man. But listen, as you know,
comment here,
you could write a book about it, man. You could write a book about all the stuff that you've seen as a landlord over the years. I'm sure.
Yeah. True story. A true service animal is legit, and we can feed them.
Yes.
Right. How does my dog pay rent? It doesn't have a job, but guess what? You do. Okay. And you're choosing to have that dog. It's your choice. Nobody put a gun to your head and say, take this dog home. Right. It's your choice. All right, Hervé, moving on. Let's see. Michael Di Giovanni.
Okay.
My friend who was on live last week. By the way, guys, don't forget to click that link if you want to join me in Hervé Live. If you guys want to earn some free stuff. Michael was on last week with me, Hervé. Michael is going places and is looking at some deals in Tampa. But what do you want to know right now? Maybe you can talk this through with me, Hervé. Can you explain the underwriting process?
All right, here's the thing. Michael was just on office hours. He asked the same question. And I told him that we are going to have a boot camp session in which we discuss the underwriting process. Because truth be told, Matt, this is a very loaded question. So I would prefer to get something, Michael, a little bit more specific. What within underwriting? Because we can't. Underwriting is huge. It's how to manage a property type of a question, right?
Well, let me boil down Michael's question a little bit.
Okay, that would help.
Okay. Hervé Francois gets a deal because that's a fact, right? Hervé is our market hunter, right? He is our relationship manager, our market hunter. He heads up our acquisitions department at DeRosa Group, right? He's the guy. When we do a deal, it crosses Hervé's desk first, okay? So deal hits your desk, and it is because first questions Hervé going to ask is this in our target market? So if the deal's in Albuquerque, New Mexico, no, we're not in Albuquerque, New Mexico. We're in the Carolinas, period. That's it. So deal shows up that is in it's in the market you're in. Okay. next step. What's the next thing you do? Give me the next 3 steps you do in when you evaluate a new real estate deal that hits. What do you do?
Well, I like to go ahead and take a look at the offering memorandum. Came with one. And I just kind of like to comb through the more important pages. A lot of these offering memorandums, 50, 60, 70 pages, depending on what broker you go through. So you don't have time to read 50, 60, 70 pages. So I skim through some of the more important pieces. I don't really do, I really skip the market part because it's copy paste from all the other offering memorandums. Plus, I myself just finished doing.
You already know Charlotte.
I already know.
Charlotte's amazing.
I don't need to know about the Duke Blue Devils again. Right. Thank you. I got it. Right. Duke University's and right. So yeah. Moving on. So I, look, I took a look at the property. I take a look at the numbers. I take a look at the occupancy, the vintage. I take a look at the rents that they're currently getting, the rents that they say they could get if they renovated. Some of these units have already gone through proof and concept of renting and so on and so forth. So I'm reading that offering memorandum. I want to get a feel of the deal. I want to get a feel of the property. I'm going to go, the second thing I'm going to do is I'm going to go ahead and go to Google Maps. I'm going to put the address of that property on Google Maps. I'm going to take a look at it. I'm going to see the surrounding areas. What other commercial entities are around this apartment complex? What are the stores? I'm looking at stores, malls, restaurants, universities, hospitals.
That gets you excited.
Yeah.
Places to shop, places to work.
Absolutely. Universities, hospitals get me really excited and whatnot, right? Because so-called recession-proof and always needed and things like that.
What turns you off? You look at a piece of property, Hervé, and you're like, "Oh man, there's that around the corner." What like when you look around the surrounding area? What are you like? Ooh.
Yeah. Well. Now I'm taking a look at if I'm not liking it, I'm looking at if it's surrounded by, for us, Matt, for what we look at, if it's surrounded by a bunch of dollar centers, if I don't see a mall nearby, a university nearby, a hospital nearby, an airport nearby, if I see a lot of train tracks, going through and things like that. Now I'm getting like, what's up with this neighborhood? What's up with this property kind of a thing. So, and then from there, I'll start doing some research on the crime that has been at that property and around that property. And I'm taking a look at the volume. I'm taking a look at the type of crime and take a look at the volume of crime, how frequent and things like that. So those are the things. Now, again, so it's a checklist kind of what we're talking about here. And if things, look good, kind of pass muster in regards to the location, from there, we'll go ahead and we'll start underwriting. And as you know, underwriting is a very big process. We do have an underwriter here at DeRosa. It does great work for us. And so I'm going to talk to him about, hey, listen, here's the OM, here's the T12, here's the trailing 12 of the profit and loss. I should just say T12 just to explain it. So it's the trailing 12 profit and loss, how this property has performed over the past 12 months, both revenues and expenses. And then on top of that, the latest rent roll. So I'm giving him those 3 items, and he's going to start doing it. And when I'm giving him those 3 items, I'm also talking to him about some assumptions that he can go ahead and put in the underwriting model. Hey, you know what? Let's assume for this market that rents are going to grow 4, 5, 6%, something like that over the next 7 years, or we're going to, we're going to scale that rent growth over the next 7 to 10 years. If the property is at 95% occupancy now, we're going to forecast a drop in occupancy in the first year before it goes up and things like that, right? So I'm going to give him some assumptions along with those 3 documents. And he's going to start underwriting, right? And then we're going to discuss it a day later. We're going to talk about the results of that underwriting. Obviously we have investors that we, raise money from, and we have to pay them a return. And so I'm taking a look at the returns that we're able to pay our investors based off of this underwriting. I'm taking a look at the returns based on the amount of debt that we have to take on for this underwriting. I'm taking a look at the sensitivity analysis that he did to see where do we have some wiggle room, some leg room into how this deal improves or doesn't improve.
All right. One last question. Because you threw out a term that we use a lot, and this is one of our key components we use in our underwriting. Michael, I hope you're still with me here. What is a sensitivity analysis? Real quick.
Oh,
You don't have to we don't have to get a deep dive into
yeah,
it. The
yeah.
factors we use, but what does that even mean? Sensitivity analysis.
Yeah, no, it's a great question. So on the sensitivity analysis, Michael, we're trying to take a look at how sensitive, what kind of an impact does moving certain variables have on our internal rate of return and our cash on cash returns for our investors. You can pick which variables that you would like to take a look at that have that impact on your IRR and your cash on cash. Some of the variables that we look at specifically is rent growth as well as cap rates, particularly the exit cap rate. So what that cap rate would look like at a particular sale kind of a thing. We also take a look at what the rent growth looks like based on occupancy. Well, hey, what if we get the occupancy to 92%? What if we get it up to 97%? What kind of impact does that have on the IRR? If we're getting something that's at 89%, we think we can forecast it to get up to 93%, but the properties in that market are operating at 98%. Okay, what does the IRR and the cash on cash return look like if the occupancy does get up to 98% and so on and so forth? So we like to see where we are in the middle. We don't take the worst case scenario because we like to buy properties. But we don't take the most aggressive scenarios either because we like to be conservative. So we take a look in the middle, and then I'll talk to you, Matt, and Justin about, hey, this is where we could potentially have some wiggle room in this deal based on what the sensitivity analysis is kicking out with the variables that we have in there.
Yes, that's well said, guys. And again, the deal's likely, hope for the best, prepare for the worst kind of thing is what a sensitivity analysis is all about. So we want to know is if the market swings down a little bit, is this deal going to be in a negative? Is this deal going to be underwater if the economy doesn't keep doing what it's been doing? And if things shine a little bit, if the sun comes out tomorrow and things shine a little bit better, what's the best we could do on the property? So that's what sensitivity analysis does is it gives you full spectrum, worst case, best case, and you're likely going to land in the middle somewhere. Michael, stay tuned in the Bigger Pockets boot camp. We're going to be doing deep dive on analysis. We've got a surprise guest coming up who's going to be going through a tool that he has that he markets for underwriting, very affordable, and so he's going to be coming on in a couple of weeks as a guest appearance with you guys. So stay tuned for that too. All right. Okay. Now this is from our boy Hone, our friend. Wanted to know, question that comes up a lot. How much GP equity do you give away and to whom? Example, the earnest money deposit person may get 5 to 10%. Who else should we consider and how much? Okay. Well, you want to try and keep as much as the GP profit as you can to the folks that are the founders and operators of the company. But at the end, because you know what, the GP profit is it's not like you're just giving this stuff away like candy. You've got a company. It's not there's the company that you're building, and then there's the deal. And I think that you shouldn't give away so much of that deal that you can't feed the company. And so the company, the partners of the company are me, Justin, and Hervé. And so me, Justin, and Hervé need to keep our machine healthy that we built, the DeRosa machine. And so we are very scrutinous on how much of that GP side equity we give away. That said, you got to give away some equity sometimes, and that might go to some people that help you front the earnest money deposit. Maybe there's someone who brought us a deal. Maybe there's someone who's helping Justin on the asset management side, and as a performance bonus or something like that, they're getting GP upside. Right? So maybe those things are happening. Maybe there's other things, Hervé. Maybe somebody's helping us raise some money. You can't just get compensated for raising money. You got to be a part of the company long term.
Right.
And that's, you can't just raise money and then go away. You got to be in the conversation. But there are other factors. Maybe someone's sponsoring the loan. Maybe you just getting started don't have the balance sheet or the net worth to get approved for a loan. So you got to bring somebody in who has that net worth. Maybe perhaps that's some equity you get. But Hone, maybe you're asking me for to break down the percentages that you got to give away. There's no law that says thou shalt give 5% of the GP side equity to someone that posts earnest money deposit, or acquisitions, bringing in a deal gets you 10% or whatever. I'm not going to go into those numbers because It doesn't matter. There's no rule that says it has to be. And every deal's different. And so it's a negotiation, conversation, win-win. But the bottom line is you want to try and preserve as much equity as you can for, remember, the deal and the company home, right? And too many people get too hung up on the deal when really you got to be thinking about is the long-term longevity, not this deal, but the next 10 that you're going to do, right? What do you think, Hervé?
Yeah, no, you're 100% right, man. Every deal is different in the way that we go ahead and structure it. And you just want to, make sure that those folks that are coming in with EMD, those partners, are going to get compensated. I mean, listen, investors are not investing in a deal as because it's a volunteer check, right? I mean, they want to return on their money, right? And Matt, I think we want to return on our efforts. And we run into investors sometimes, and they want to know how much we're getting paid off of a deal, and so on and so forth. I'm like, so we don't do this for free, right? I am involved in nonprofit organizations, but that's not what this is, right? And so, but at the same time, we also tell our investors that we like to align ourselves with them. And when they benefit, then we benefit, and we work for them first, kind of a thing. So, and I think it'd be very hard pressed to go ahead and find, real estate groups out there that, are not, compensating themselves for deals and whatnot. So you're going to see different kind of GP splits, the general partner, what the general partner takes versus the limited partners. You'll see that across the spectrum. Whatnot. We try to stay pretty consistent ourselves on our GP LP splits. We've looked at other structures, and one day we will put out another structure. But we try to be, pretty consistent because it's what we know. It's what our investors have got to know us for. But we don't ever want to say 100% no to a deal simply because it does not fit in the structures that we've used in the past. If we need to be flexible in that structure, then let's do so.
And I'll say this to leave it here with you guys. You will need to get diluted a little bit in the beginning, a little bit in the beginning, and give a little bit of equity away to help you get your legs underneath you, get a few track record deals done. But the more you give away, it's like crack. The more you give away in the beginning, the more you're going to have to give away in the future, because you need to preserve as much of that GP side as you can so that you can reinvest in your business and not rely as much on third-party capital raisers, and learn how to raise more and more capital yourself every year. Every deal you do, you should be getting more and more equity for yourself so you can reinvest that equity you're getting and the returns and the fee structures and the fee cuts that's giving you back into your business. If you give a lot of equity away every deal that you do, then you will be giving a lot of equity away every deal that you do, because you won't be getting that revenue stream to reinvest or recycle back into your business, so that you don't have to use third-party capital raise anymore. So you don't have to use. Remember, the reason why you guys have to bring somebody in to float their balance sheet across is because you don't have the net worth. But if you get more and more GP equity, guess what you're going to have?
That's right.
More and more net worth.
You
can underwrite. You can sponsor your own deals after you do a few deals, right?
Exactly.
So again, if you give more away, you're going to keep having to give more away. But the more you keep for yourself, the more you can reinvest back in. Do some hires. Hire an asset manager. Hire third-party capital. Hire capital raising in-house. Underwrite and sponsor your own deals. Okay, all that stuff. So I recommend to all you guys that you think about, one more time, two different things: deal and the company. And make sure you're thinking about the company above all else. The long-term longevity of you being able to do the next 10 deals versus just this one deal. Okay. All right. Okay. I love you, Claudia. Claudia Ho, is there blood in the streets yet, Hervé? I know you and I both know Claudia. Are there deep discounts? Oh yeah, everybody's selling at 50% off. The blood's just running right down the road. No, unfortunately, multifamily is still really popular. And understand, guys, unfortunately, cap rates they're not going to go up anytime soon just because interest rates are going up. What would have to happen is multifamily would have to be a less desirable place to invest. People correlate interest rate and cap rate. They're not. They're not directly correlated. So just because interest rates are going up, that doesn't mean that the affinity that the investor base has for multifamily is going to become less. People are still going to try and make it work. What do you think, Hervé?
I agree with you 100%. I was going to even say on top of that, Matt, maybe even more so, right? Because they are less. They're less attractive to the stock market. They're less attractive to the stock portfolio. So they're like, okay, where am I going to find yield right now? Okay, and so one of those areas obviously is real estate for the returns that real estate can provide you over the long run. Even though yes, it is illiquid, but if you're looking to go ahead and just park your money somewhere as a bank account, guess what? Now you're seeing different type of cash yielding instruments out there because we're in a rising rate environment that can look a little bit attractive, right? Where before, these instruments, CDs, whatever it might be, used to be yielding 2-3%. Now you might be them seeing.
You can't just rely on that, Hervé. You know what that is?
5-6%. No, what's that?
That's the Dow Jones Industrial Average the last month.
Woo! Giddy up, baby.
Whoops. Yeah.
Well, we're down.
And I'm not throwing rocks at the stock market, but more and more people, and the Dow, by the way, for the first time ever, the first time in a long time, the Dow just broke under 30,000. It's 29.3 now.
Yeah.
So people can. By the way, that's Bitcoin today. That's just today.
That's just today. That looks ugly.
Again, I'm not saying we're any better. I'm saying that people are going to start going. They're not going to start. They're going to continue, and even more so, go other places for places to build their wealth.
Listen, we got to remember, folks, right? The 5 profit centers for real estate, and you don't have as many profit centers for stocks, right? For stocks, you pretty much just have your appreciation. And if your stock happens to pay a dividend, then you have appreciation and a little bit of dividend income. Talk about your PSE&G utility. Have fun with that one, right? But other than that, when on stocks, those are your 2 levers, and you can't control either one of them. You have to wake up and cross your fingers and pray that Elon Musk ain't saying something stupid today that's going to hurt that stock, right?
But
good luck with that.
No, he's good at that, man.
Right, exactly. I'm going to buy Twitter. I'm not going to buy Twitter. Head fake. Nope, going to do. Right. So it's
just have somebody he runs these things by. Like, hey, man, listen. Why don't you just run by me? Just anybody, any other human being before he's allowed to put anything on Twitter or say anything into a microphone. Like, hey, why don't you just say it to me first?
That'd be too boring. That'd be too boring. But we know the 5 levers, right? We've got appreciation in home values in real estate. We have the rental income that's going to obviously drive our cash flows in real estate. We can go ahead and pay down principal using that extra cash flow from the rental income we're deriving from that real estate property. We got inflation hedging because in a rising rate environment like we're in right now, you got values of